And we are live, guys. I got George as our guest today. Now, George's background, he's a serial entrepreneur. He's built multi-million dollar businesses. He has an amazing YouTube channel, which I have the link below this video. Please go check that out. And I was watching, George, I was watching your latest, I don't know if it's latest, but one of the most recent videos talking about the repo market.
Mm,
And obviously, we're in this pandemic right now. Coronavirus is around the world. Economies are getting decimated.
yeah.
I mean, absolutely decimated. The Federal Reserve seems to be on the MMT theory right now. Forget about deficits, forget about debt. We will print unlimited money, like something right now, like $3 trillion is being printed, and interest rates are zero. So I love to take you. I love to get your thoughts on this. Like, what's happening within the market? Where do we go from here, and what can we do about it?
Well, those are a lot of questions. We'll start with what the Fed's doing. They're just throwing the kitchen sink at it, or everything, including the kitchen sink. It's just, even in my wildest dreams, I couldn't have foreseen this happening. They took the overnight repos from, call it 125 billion up to 175 about a week ago. And then let me know if you want me to explain how the repo market
Yeah,
works.
sure. That'll be great if most
I'm not
people don't
sure
even
your
know what the
your
repo market is.
audience.
Yeah.
Okay, okay. All right. So for those in your audience who aren't totally familiar with the repo market, it's basically just a transaction between financial institutions, hedge funds, a variety of different players where they'll have collateral. Let's just call it a U.S. Treasury, and they'll say, listen, we need some liquidity, or in other words, we need some cash overnight. Let's say they're a bank and they've got someone that wants to pull out a big deposit. Okay, and they might not have the reserves or an adequate reserve ratio to meet the amount of deposits that they have because that one person's pulling out a lot of cash. There's just a million things that could lead someone to come to that need for cash. So then they say, okay, we've got this treasury. We'll go ahead and give you this treasury overnight. You give us the cash we need. We're good to go. And is really not a loan technically. It's supposed to be a sale. Now there's a lot of gray area there, but that's really the bottom line. So they've got overnight repos, which are repurchase agreements, and then they have term repos. So a term repo is just, okay, we're going to go into this transaction for 14 days or for 52 days or whatever it is. That would be a term repo. So the entire repo market, and I think a lot of people that even understand what repos are don't understand that what the Fed's doing is just a tiny fraction of the overall repo market. It's prior to the craziness that we've seen. The repo market has about 2.2 trillion transactions daily,
Mm.
or in dollar amount, and that's not including the reverse repos. So it's a big market. So what the Fed had to do starting September 17th, when we saw that big spike in interest rates in the repo market, that's when everything froze. So people were willing to pay up to 10% overnight when the Fed funds rate was at, I believe, 2.25%. I mean, it was completely unprecedented how much those interest rates spiked because there was a lot of people needing cash and no one willing to give them cash.
Hmm.
You get the supply and demand there. So the Fed since September 17th has had to intervene in the repo market. Of course, like everything they do, it was supposed to be temporary. And that was what, 4 or 5 months ago now. We're still doing it. And what's happened with the coronavirus is it's taken things to a completely new level. And I mean, it's just astronomical what they're doing. So they were doing 125. They beefed it up to 125 a night, 125 billion a night in repo. Now, this is a commitment. So a lot of people get confused. They think that if the Fed is committing to 125 billion a night, that means they're actually putting that money into the market, or they're lending that to the primary dealers. That's not the case. That's just a commitment level. And then it's up to the primary dealer banks to decide how much of that 125 they want or need. Now, it can be oversubscribed. So the Fed will come out and say, okay, we're committing for the next week to do 125 billion a night, but there could be 150 or 200 in demand, and then
Hmm.
be oversubscribed, and it can be undersubscribed. So it just because they say we're committing to X, it doesn't mean that that's how much they're printing, right? You have to go to their website, the New York Fed's website, and they list it out there for you every morning about 8:30 what they're doing. So moving on to this week, they came out and said we're upping it from 125, I think it was, to 175. And then what they started doing on either Tuesday or Wednesday, they said we're adding another 500 billion. So it went from 175 in the morning to 500. And they said we're doing another 500 in the afternoon. So they're committing to $1 trillion dollars of repo every single day. Now, this is supposed to stop Friday, but who knows? Again, like everything they do, it starts out as temporary, and a lot of those.
And do you think the purpose of this is trying to get stock buybacks to propagate the market?
Oh, there's so many reasons why they're doing this. The repo market, it's important for people to understand that is the main dollar funding mechanism we have in financial markets. So that is the plumbing. That would be like, let's say you've got a house and your main plumbing line gets clogged up going out to the street. You're screwed. You can't flush the toilet. You can't run the sink. You can't do anything. It's all backed up. That's the repo market. So if that doesn't function properly, it has not just with corporate buybacks, but with my goodness, the corporate bond market. I mean, mortgage rates let's just say they would have left it at 10%. So that means the Fed funds rate would have naturally come up and all the short-term rates would have gravitated toward that 10%. Well, that means that interest rates across the board, I don't know how far out the yield curve it would have gone. I don't know if it would have gone all the way out to the 10-year. I had Luke Groman on for an interview, and he was saying that if they would have let it stay there, that would have even affected mortgage rates, implying that the 10-year would have gone up to that level as well. You can imagine what would happen if people just overnight, and people, I mean Americans, overnight just had to start paying 10% for their mortgage.
I remember that happened in Canada, went up to triple digits in the early 90s. My father was telling me it went from single digits to high as 21%, and like everybody got foreclosed. Like no one can afford it.
Yeah. I mean, just you can imagine what that would do to your payment. If you can't, you just pull up a mortgage calculator and type in your current rate, call it 4.5%, and then do the exact same numbers with a 18% or 12%. And most people say, oh, that's crazy talk. Well, you got to realize going back throughout history, mortgage rates, if you look at the average, a normal mortgage rate is not 4%. No. It's much closer to 10% than it is 4%. So my point with the repo market, it's absolutely crucial to the stock market, to the bond market. It's so systemically tied into everything now. It would affect pension funds who are already bust, and it would just ripple throughout the entire system. And that's why the Fed is so freaked out about it, to where they're throwing all this liquidity. But the problem is it's most likely not a liquidity issue. It's more of a counterparty risk issue or a collateral issue. Most people get tied up. Even the talking heads on CNBC, they'll get just really fixated on, well, there's not enough cash. There's not enough cash. They need cash. Okay, but they forget the other side of that equation. What if there's plenty of cash, but just not enough good collateral? So you and I are doing a repo transaction. Let's say you want a repo for just called $1,000. Well, I might have $100,000 in my bank account, but the collateral that you're willing to give me, let's say, is a promissory note from your brother or something. I'm like, yeah, okay, now I'm going to pass on the collateral, right? So it's not the fact that I don't have enough money to give you, it's the fact that you don't have any good collateral.
So that's a problem right now, though. So there's no price discovery, and people are just liquidating assets because they don't trust in any of these assets, including even government bonds at the moment.
Right. And a big key about government bonds is that it might not necessarily be yours. So let's go back to that previous example. Instead of having a note from your brother, let's say that you have a treasury. Okay, well, if I'm a primary dealer or just the other party in the transaction, I may look at that and be like, wait a minute, does he really own that? Because see, it could be rehypothecated, or it could be something that you borrowed from another bank and I don't really know it's yours. And that's where the counterparty risk comes into play. If I'm a little hesitant, even if you have that treasury, which is considered pristine collateral in the repo market, if I don't trust you, let's say you're Deutsche Bank or HSBC, and I'm like, yeah, no, I saw your books. I just had lunch with your head guy, and I know that your Lehman Brothers waiting to happen. I don't care how good your collateral is. I'm not going to lend you any money, even though I've got $100,000 in my bank account. So there's three pillars that people have to think through. It is liquidity, it's collateral, but there's counterparty risk. And unfortunately, the media and 99% of the people that even understand what a repo is just get fixated on that liquidity.
So what does this mean for the market, though, you think? Well, what's your take on the Dow index? What's your take? Because I was looking at the VIX the other day. I've never seen the VIX that high ever.
I don't know if it's ever been that high. I think it got over 80, didn't it?
Over 80. I know 08 was 60. Now it's 80.
Yeah, there's a lot of numbers that we're seeing right now that we've just flat out never seen. But I think it's important that for the average Joe investor out there, you've got to start by asking yourself the question, is it cheap or is it expensive? And I always try to encourage my viewers to think of things this way. And most people, 99.9%, they start with asking the question, do I think it's going to go up or down in price? Right? Whether they're looking at a stock, maybe an index, a commodity, a home, is it going to go up or down in price? Wrong question. Don't worry about the price. Put that on the shelf. Think about, is it cheap or is it expensive? So when we overlay that mindset to the S&P 500 right now, although it's come down, call it 30+% in the last 2 or 3 weeks, it's by no means cheap, historically speaking. And you can just look at a CAPE ratio and you look at it adjusted for inflation and by all these metrics. Or another one that I really like is the market cap to GDP. So what you're doing is you're taking the market cap of the Dow and you're comparing that to nominal GDP of the United States. A lot of people call it the Warren Buffett indicator. And this is great to tell you if it's cheap or if it's expensive. Back in the early 80s, that number was about 30%. So market cap was 30% of nominal US GDP. As of a month ago, call it, we are at an all-time high at 150% of GDP. That means the stock market is grown way, 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 way bigger than the real economy. And so you get the tail wagging the dog type thing. So now we say, well, it's got to be down a lot. Yeah, not that much. I mean, it's still, call it 120-ish. And so historically speaking, that's still not cheap. So now there are certain stocks like oil stocks or like the cruise lines that have just been pummeled, and you could probably find some cheap deals there. But I'm just talking about the market overall. In order for it to have that label, it's got to go down quite a bit further. So how far? I would take it, I'd look at the lows on the S&P going back to 2008, and then I'd adjust it for inflation to find out kind of where we are. I know the lows, I think it was around 666. So figure adjusted for inflation, maybe we're around 1,000. And then I'd look at that. I'd look at the CAPE, and then I'd look at the market cap to GDP.
Yeah, and I mentioned this earlier in my last interview too. You mentioned oil too. What's your take on the whole oil wars right now? This is obviously playing in the background. A lot of people aren't really talking about.
Yeah, I mean, it's a perfect storm in the oil market where obviously we have what's going on with the coronavirus. So you've got a demand shock. And what's interesting about the coronavirus is it's incredibly unique from an economic standpoint because it could produce not only a demand shock, but a supply shock at the exact same time. Now, I'm not talking about oil, but I'm talking about just consumer goods. And it's a very, I tried to find some time in U.S. history where we've had something similar, and I personally can't find it. Maybe your viewers know of something. But so my point with oil is you've had this huge demand shock, and then at the same time, you have Russia and Saudi Arabia coming together to try to reduce supply to keep the price up so they can make a profit or a decent profit on each barrel that they pull out of the ground. And then they have their big pissing match, or I don't know what you want to call that, but whatever it was. Now, I don't know if it was strategic. I don't know if it was just them, hot-headed. I would assume that it's strategic when you're dealing with at that level. And I don't know why they did it. Did they do it to knock out the shale producers? Did they do it for some? I don't know. I'm not an oil expert.
You think they might be competing against the fracking that's happening in the States?
Oh yeah, for sure. Because fracking, what happens is their cost to get the oil out of the ground is extremely high. Call it $70. That's not an exact number, but just for an example, let's say it's $70. Where Saudi Arabia is $9. So if Saudi Arabia brings the price of oil down to $20 or $25, they're still making profit, where the shale guys are losing $50 every single barrel they pull out of the ground. That's a bad business model. You're not going to last too long.
Nope.
That one. So, and since the last 8 years now, the shale producers have really blown up in the United States and in Canada, and that's created a lot of supply that now competes with Russia and Saudi Arabia. So could this be a circumstance where they are looking at this saying, okay, we know the coronavirus will have a huge impact on demand. Oil's already going down. Do we do this to really give the knockout punch to the shale producers? It's kind of a conspiracy theory. It's fun to think about. I would have no proof or any data that would suggest that. But I can tell you one thing. If I am running an oil company in Saudi Arabia or in Russia, and I'm thinking to myself, okay, how do I knock out my competition? It's definitely something I'd consider.
No, I agree 100%. But let's kind of like switch gears and let's talk about, let's say for the average Joe, people like all of America, middle America, people working 9 to 5, which is like 98% of the people. They have a mortgage, they have payments, student loans, all this shit.
Yeah.
What do you think is going to happen right now?
Boy, it's going to get ugly. The unemployment rate, I would assume that in the United States, it will go at least into, 10+%. It'll get in double digits, I think. And I mean, it's not a far cry when you look at 2008-9. I'm pretty sure we are in double digits there. I think this is going to be worse from an employment. Okay, are we there?
Yeah, we're back. Yeah.
Okay, sorry about that. So I don't know who that was, but anyway, so we get into low double digits, call it 12, 14% unemployment. And that's the way it's measured now. People have to understand that it's measured a lot different now than it was in the 70s or the 80s. So 10% unemployment now would be more like probably 15 or 20% unemployment back in the 70s if it was measured apples to apples. It's a lot like CPI, where they've really kind of messed with the way they calculate that. But I would see that I don't know how it can not get that high when you have all these restaurants shutting down. You have the economy of the United States is very consumer driven. It's very service oriented. So if you have all those things just coming to a halt for, call it, a month or two, that's going to have a huge ripple effect. I was looking at numbers from JP Morgan, and I think they're probably being pretty optimistic, but they were saying in either Q2 or Q3, I think Q2, they're projecting negative 14%.
Wow. 14%.
GDP. GDP, not unemployment, but
Okay.
GDP. So how does that ripple through the economy from an unemployment standpoint? The bottom line is people are going to struggle. It's going to be tough for them to pay their bills. And that just goes back to the kind of fundamental of the Austrian school mentality that savings are very important. And I think in this world of modern money creation, where you technically don't need deposits or quote unquote savings in order to increase the money supply, so people tend to just blow it off. And a lot of Keynesian economists think that savings is actually detrimental because that money's not getting out and circulating within the economy, although it is, but they don't see it that way. So that's a whole nother topic. But the point is, this is a great example. Right now, we're seeing it with on the household level, and we're seeing it at the corporate level, why savings is so important. If we were, let's call it Japan, where they have a 30% savings rate. Well, if you have to stay home for 2 months, you can weather that storm.
Mm-hmm.
Look at the corporate, if all these airlines wouldn't have spent 96% of their free cash flow on buying back shares over the last 8 years, well, they would have reserves, they would have money, they would have some dry powder to weather the storm. So
yeah, but they know it's a house of cards. Like you look at the EBITDA of all these like S&P companies or the Dow Index, they're all negative. None of them actually producing profit. And
yeah, but their share price goes up because they're just buying back their own shares. So
of course, they want to propagate their own shares and cash out. Like 6 months ago, the top CEOs start leaving the companies. Like, what the fuck's going on there?
Yeah,
And
I
you
think
mentioned the Keynesians. Like,
mine.
for some reason, Keynesian forget like Gresham's law is like bad money drives out good money. Like, you need to keep good money, or you can even substitute money for assets or store of value. And it's
the real problem we have right now too is that our economy has been so financialized that the not the only way, but what a lot of people perceive to be the only way for them to increase their purchasing power substantially, because you have real wages that are relatively flat. That's wages adjusted for inflation. But so they look around and they say, oh my gosh, well, my buddy down the street, he just bought his home, call it 5 years ago, for 200,000. Now it's worth 500. His 401k has gone from $100,000 up to $200,000. So my buddy, by doing no extra work, by producing no more goods and services, has increased his purchasing power by, call it $400,000. So then what does that person? Well, then they invest in the stock market. So all of their assets, quote unquote, are or all of their purchasing power is in these assets such as real estate or their 401k. So if these prices come back down to where they should be, gravity takes over and we go back to a historic norm, unfortunately, not only do people lose their jobs and the economy take a big hit, but on a moving forward basis, the economy takes an even bigger hit, because all that purchasing power that was just on paper has now just gone up in smoke, and you don't have it anymore. Look at the baby boomers who retired and have been retiring the last few years, and they had, let's say you're a baby boomer, you've got $200,000 in your 401k as of 30 days ago, and that's what you're going to use to retire. Well, okay, now you've got, call it 100,000 in your 401k. Your purchasing power just got cut in half. And you think that person's going to keep their money in the market and risk what's going to happen over the next couple months with the coronavirus? Absolutely not. They're going to pull that out and they're going to realize those losses, and they're not going to go back in. And if you're 70 or 80 years old and you're in that situation, you've got to come to the realization that your only option is to be poor for the rest of your life. That sucks. And yeah, exactly. You're yeah, that's a good way to put it right there. And unfortunately, it's a result of, number one, the Fed, because if we wouldn't have inflation, if stable prices were actually stable prices and not 2 to 3% up every single year, which since 1913 has resulted in 2,000% inflation. The dollar has lost 98% of its value. And people say, oh yeah, George, I hear about that all the time. What's the big deal? Well, the big deal is it creates an environment where people have to go into asset prices. They can't keep their money in the bank because we have negative real interest rates. So you have to do something with that money. That creates a bubble. And when that bubble crashes, it affects far more average Joes than it would have otherwise done. Now, I want to go back to what the average Joe can do. And so I always suggest, if you have a mortgage right now, make sure that you have a fixed rate 30-year mortgage. It's just absolutely crucial. The Fed is going to take their balance sheet, and let me say that in layman terms, the Fed is going to print trillions of dollars over the next 3-4 months. I mean, trillions and trillions of dollars. Why is that a big deal? Before the GFC, the Fed's balance sheet, meaning how much money they had printed in aggregate total or net, was $800 billion. That was kind of base money, if you will. Then it went up to 4.5 trillion after all these rounds of quantitative easing. Well, where is it going to go now? Is it going to go to 10 trillion? And if that does get out into the economy, that's a big if, but if it gets out into the economy and just doesn't sit in the reserve accounts of the primary dealers with the Fed, then you're going to have just a very simple equation where you've got a lot more money chasing the same amount of goods and services. But the caveat to that is, because of the coronavirus, we could have a lot more money actually chasing fewer goods and services over the short term because of that supply shock, because all the global supply chains have been shut down and potentially will be shut down a lot longer because of the coronavirus. So my point is that could be seriously inflationary. And we could see a situation where asset prices are decreasing or experiencing deflation, and higher ticket items are experiencing deflation, such as cars. And then everyday staple goods like food is going up substantially in price. But over the long term, it's most likely, and when I mean long term, I mean 5 years, 10 years, for the dollar to continually lose value domestically. Now, it can go up against other currencies outside of the United States, but as far as the purchasing power that the average person has on a daily basis, that goes down. That means that the value of the dollars that you're paying your mortgage back with actually decrease. So that's a transfer of wealth from the lender to the borrower. In other words, that's a transfer of wealth or purchasing power from the bank to you. And if the rate of inflation exceeds the rate of your interest that you're paying on your mortgage, which it most likely will, especially if you can lock in like a 4% mortgage, any rate of inflation above and beyond that is purchasing power in your pocket.
Yeah, I always show people this. Let me pull it up. But let me put this up. I find it hilarious to show people this. This.
Yeah, exactly.
They don't get it. I'm like, listen, guys, your dollar's useless.
Yeah. And I would also, I'd like to see, okay, so you've got this chart right here, which I think is fantastic, Ameer. But what would be really cool is to have that exact same chart for the 1800s. And the reason I say that is because it was the opposite. From the year 1800 to the year 1900, prices went down by 50%. So you would have had the opposite chart right there. Your dollars would have gained 50% of value over that 100-year period. And if you really take it to kind of peel back the layers of the onion and think about what that means, it changes everything. Instead of someone just trying to get ahead and working harder and harder and harder and having to invest in the stock market and all these bubbles and all these asset classes or all these asset bubbles that the Fed's inflated with all this money printing, you could just work the same job. And I did this in one of my videos where I showed a McDonald's worker that's making, let's say, $1,500 a month take home right now, and their bills are $1,500 a month. So they're they're not saving a dime. They can't afford to. If we went through a type of deflationary environment, that we saw in the late 1800s, that's what I use, from 1870 to about 1900 for my numbers. Well, we had about 3% deflation per year, but nominal GDP actually went up while prices were going down. So did wages in nominal terms. So that's at the end of 20 years, that same McDonald's worker, if they never would have, if they're still flipping burgers, the exact same job, their wages would have gone up by about 1% per year. So now they'd be making $1,800 a month. You say, George, that's nothing. After 20 years, that would be terrible, right? But you're not thinking about their expenses. Their expenses go from $1,500 a month down to $800 a month. So now all of a sudden, just because of deflation, just because we've let the free market do what it naturally does, and that's entrepreneurs creating goods and services at increasingly lower prices more efficiently, that person has $1,000 a month going into their back pocket, which, oh, by the way, has more purchasing power than it did 20 years ago, that amount that they're saving. So that takes care of everything. If we had 7% real interest rates, let's call it, and we had a fixed money supply or limited money supply, and I don't care whether you limit the money supply by tying it to oil, Bitcoin, gold, I don't care how you do it.
I think we have to go. Do you think it's possible we go back to a pegged fiat system?
Yeah, it's for sure possible. You got to look at, is it possible or is it probable? And I think in the next, call it 2-3 years, probably not. But if you have a situation like we've seen the DXY, I think it's at 102 now. That's crazy. And if it gets up to 110, and what I'm talking about for most people is that's the dollar index. So if you have a basket of currencies compared to the dollar, if that number goes up, that means the dollar is getting stronger against that basket of currency, most heavily weighted toward the euro. So I don't know if you saw this, but last night the Aussie dollar just dropped. It went down by like 25%. That is insane for a major currency. For a major currency to go, I can't imagine that that's ever happened before, just that quickly. And I mean, think about that. If you're an Aussie and your dollar buys, let's say 75 cents, and you wake up tomorrow and it buys 50 cents.
We're in the same camp. I'm Canadian. Our dollar's getting fucking hammered.
Oh, did you guys get rocked last night too? I was just
man. Everyone's getting rocked compared to the greenback.
Yeah. So what happens is a lot of these countries, they borrowed a lot of money in 2012 to 2014 when the dollar was at like 70 on the DXY. Yeah. And we had the 0% interest rate policy. So all these corporations outside the United States and countries load up on dollar debt. Well, now all of a sudden they're having to pay back those debts, and they're trying to, their revenue is in their own currency, but your debt payments are in the dollars. So every time that the dollar gets higher, that means the value of your debt increases. And then to make matters even worse, if you're a country like Colombia, where I am right now in Medellin, they have a good percentage of their GDP comes from oil. So that's how they get their dollars to pay back all that debt. Well, if the price of oil goes from 50 a barrel down to $20 a barrel, think about how few dollars you're getting now in order to pay back your debt. What's the only option? Print money. That just creates inflation, and then you go into a potential hyperinflation mode. So so my point is, the dollar going up to 110, 120, that collapses so many economies around the world. And since everything is so interconnected, that could potentially bring down the entire global economy. I think that if it got up to 120 or so, the only solution would be for them, meaning the major countries, to come to like a Plaza Accord 2.0, where the United States intentionally devalues the dollar and the global markets. They would just have to print up, call it trillions of dollars, and just flood the currency market with it to bring down the
But this
value.
goes back to what I said of Gresham's law. Like that capital flight needs to be stored in some type of value, whether it's going to go into Bitcoin or gold or some type of raw commodity of an asset. No, and so then my question is, what do you think in the next couple of years, from a narrative perspective, do you think people will gravitate towards?
Boy, the next couple of years, that's really
I
difficult.
know, like you said, it's uncharted territory. Like you mentioned earlier, this type of scenario with this black swan event that happened with Corona, it's almost like the perfect storm. So the coronavirus, the oil wars, were over leveraged. No one has any savings. It's like pretty much everyone's fragile. You know, you just you
Yeah.
move that one Jenga piece and everything falls apart, as Nassim Taleb talks about. And so I look at it, I'm like, it's a zero-sum game. No matter what, capital flight has to go somewhere. And so where's going to be that global consensus among people in the money game where money gets parked?
I think it really depends on how effective the Federal Reserve is at buying stock.
Mm.
And so, and I think obviously you can tell by my statement, I'm implying that I think that's what they're going to do. In fact, I think they're already doing it
I
through.
heard, I heard, I heard they're just taking straight equity. Yeah, they're just buying the stocks themselves.
Well, it's through this. They've got all these 4-letter acronyms for all these programs that they've set up, and basically what they've done is another program that in essence it's just like the repo transactions we just talked about, but instead of just taking treasuries or mortgage-backed securities, they're taking corporate debt, they're taking stocks, they're taking anything as collateral from all of these primary dealers. So in my mind, I'm thinking, okay, well, why wouldn't the primary dealer, if the Fed wanted to, they say, hey, buddy, go do me a favor, buy $50 billion worth of Apple shares, put it onto your balance sheet, and then we'll lend you the money for it. You get the cash reserves. We take those Apple shares, put them onto our balance sheet. Technically, you lent them to us through this program, but really, I think it's the Fed out there either bailing out those primary dealers because they've got a lot of toxic garbage on their balance sheet, and or kind of setting things up to where they can start buying the market, whether you want to call that the plunge protection team or whatever you want to call it.
This is like classical Marxist communist playbook, like the CCP in China. It's
Banana Republic. It's
Banana Republic. Yeah.
It's just, it blows your mind that it's come to this. But so since they have those tools at their disposal, who knows if people go back into the market because it's going back up, because there's not only an implicit Fed put, but now there's an explicit Fed put, in the sense that they're just buying shares or buying corporate debt. Japan's done it for a long time. Japan's a lot different than the United States, so it might play out a lot different here than it did there. But there's a playbook for it for sure. And so that's why it's tough to say. I would say, though, that if you study 2008 and you see that crisis, that gold or any safe haven asset really sold off in favor of short-term T-bills, because that was what they could use as collateral for all these dollar funding markets. But so you really saw a gold very volatile. And what happened when it went up to Bear Stearns, it went up, up, up due to fear. But there were 3 cross currents that were really affecting gold back then. And I think it's the same cross currents now. That's fear, collateral, and liquidity. So the fear took it up. And then as soon as Bear Stearns went bust, then all of a sudden you needed liquidity and you needed collateral. And so those took over. Everyone sold their gold. Gold plummeted until the government came in and did a few things, like they banned short selling on the GSEs. And then all of a sudden fear takes over. They go all the way down to Lehman, and then that goes bust. Fear takes over, it goes right back up. And then you get the collateral issue again. It goes plummeting back down. And then the Fed comes in with all this quantitative easing and money printing. And then fear takes over and the fundamentals take over after the liquidity and the collateral, from a psychological point, was kind of in the rear view mirror. And you know as well as I do, gold just went on a massive bull run along with silver. So I think that now Bitcoin, gold, and silver are kind of those assets. And so I think when we get to a point, whether that's a month, 2 months, or 6 months down the road, where people psychologically feel as though this is behind them, but now all of a sudden the Fed's balance sheet is at $20 trillion. And they're like, holy cow, this is not good. Get me some gold, or get me something that the Fed can't print. And that's when I think you see potentially Bitcoin, gold, silver. I see those two as I don't even consider them apples and oranges. I always say, to me, it's like an orange in a Ford pickup truck. Between gold and Bitcoin, and gold and silver, I see them as completely separate asset classes that you should own for totally different reasons. But I think as far as what happened in 2008, that could be a good example of what's playing out now with gold, Bitcoin, and silver.
Yeah, I would concur. I would add one more asset class, but it's not for everybody. But it's in Canada, at least, it's been appreciating quite well. And during tough times, is actually the perfect asset to have if you can operate it, is farmland.
Oh yeah, yeah, yeah. Well, long term, I'm extremely bullish on farmland, and I like what's cheap, just like what we were saying in
Oh, it's cheap.
agriculture.
You can find here in Canada like really prime farmland for like 1,000 an acre in some areas. Like, it's cheap.
Yeah, yeah, that I think that's a great point. So there are some really great opportunities right now with the commodities, with agriculture. If people look around, I think there's some really neat things. And also too, if the Canadian dollar continues to go down against the dollar, the US dollar, then having some hard asset like that produces something that where there's always going to be demand for it. And not only that, but it produces cash flow. Then you are a price maker instead of a price taker. And you're going to have a great hedge against whatever happens to the Canadian dollar, because even if the Canadian dollar implodes, you still have that producing piece of land that has a lot of intrinsic value, and that never goes away.
I agree. I think we'll leave it at that. George, I just want to thank you so much for sharing me your insights and wisdoms. What's the best place they can reach you at? I know we have a link below this video over here, but guys, I highly recommend go check out George's YouTube channel. It's fucking awesome. I binged a bunch of his videos. But George, please let my audience know what's the best resource to check you out.
Sure. Thank you. You can find me on YouTube or Twitter, and it's just my name. So it's George, typical spelling, last name Gammon, Gammon.
Thanks, George. Appreciate it.
All right. Thanks for having me.